The fourth quarter of 2021 was underpinned by strong earnings growth, which pushed growth assets higher in developed markets and led to a third year of positive calendar returns. The factors that produced the best returns over the quarter were growth and developed market equities, the largest detractors being commodities and also emerging markets. Over the year, value slightly outperformed growth. Geographically, the US, then Europe and then the UK offered the highest returns over 2021. The end of the year saw an increase in volatility, and of course this was due to the emergence of the Omicron variant of COVID, and this impacted fourth quarter growth right across the globe. So over the fourth quarter, the wider UK equity market increased by 4.2%. And inflation was back in the picture. It increased by 5.1% year on year, and this has created further worries over wage inflation within the economy. As a result, the Bank of England reacted and they increased interest rates to 0.25%, and that was despite the rapid spread of the Omicron variant. So turning to the US, the wider market increased by 11% over the quarter, which was a strong performance. Inflation remains a theme also in the US, and in November, CPI, which is the Consumer Price Index, jumped to 6.8% year on year. That's the highest figure for almost 40 years. As a result, the Federal Open Market Committee will look to end tapering by the end of the first quarter of this year, and is likely to lead the way to potential rate hikes through the year. In Europe and beyond coronavirus, headlines have been dominated by higher energy prices, and this is leading to further inflationary pressures. Turning to defensive assets, overall performance over the quarter was muted. Markets had to absorb rising inflation and tighter policy from central banks, and government bond markets were mixed over the period. So as we start 2022, we're facing some of the key themes that we ended last year with. So firstly, inflation. Is inflation a more persistent problem? Well, if it is, then index-linked bonds and equities may benefit in this scenario. If we see continued strength in corporate earnings, this will help growth assets this year. The journey for the world to achieve net zero emissions by 2050 is happening now. And of course, this is part of that inflation story. So linked to inflation, of course, is the direction of interest rates. So how far will interest rates rise to combat inflation? This will drive whether growth or value factors perform better in 2022. And finally, global growth rates. They will be in focus in 2022, and this is likely to be driven by how soon the pandemic comes to an end. Now, what financial markets will not like is higher inflation, higher interest rates, and falling growth. That's stagflation. Given this outlook, we continue to believe that a diverse mix of growth and defensive assets are needed to provide a smoother investment journey in what are likely to be challenging conditions in the first part of this year.